The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Juliana Tuttlbaum. These are your headlines. Donald Trump taps CEA chair and tariff advocate Stephen Miran to the Fed's Board of Governors, with the president touting his expertise in global economics following months of criticizing Chairman Jerome Powell.
Europe's STOXX 600 posts its biggest daily rise in more than 2 weeks, with corporate earnings offsetting tariff turmoil as Trump's levies come into force. Futures also pointing to a strong close to the week. And threading the needle, the Bank of England narrowly votes to cut rates to a 2-year low after an unprecedented deadlock, as committee members eye an expected inflation uptick. Governor Andrew Bailey tells CNBC the outlook is cloudy.
Any confidence around that path at the moment, for the reason I said earlier about uncertainty, I think it is less clear at the moment what the path will be immediately, even though I think we're on a downward course.
It's been a busier week on the tariff front, and the latest this morning has been around some clarification for the Japanese around tariff stacking, that perhaps we are talking about a baseline rate. So a little bit more clarity coming through there. In the vein, if you look at markets, I think just wading through all the noise this week, we have seen some decent gains, just turning a little bit more cautious actually in the past 24 hours. So fresh catalyst, perhaps that's what the market's looking for. It's
interesting you're seeing such a positive reaction in the Japanese trading session. Japanese automakers in particular, given the relief around the idea that the Trump administration is not planning to stack those tariffs, that there was some concern there that we would see tariff stacking. I think when you look at markets overall, it has continued to take some investors by surprise that we're moving from strength to strength. Even in Europe, you're seeing incredible resilience of the European market. It seems as though corporates had prepared for a worst case scenario and it's just not materializing.
Yeah, we're not getting the reciprocal tariff impact because those tariffs were moved lower. I think there's another threat to markets, and we'll get into that this morning, and that is around Donald Trump's influence on the institutions. And we saw last week the removal of the head of the Labor Department. That was a key risk for the markets. Now this week, as we talk about a replacement to a Fed governor who left, whether we see some influence from the president. And the latest here is that Donald Trump has selected Stephen Miran, chair of the Council of Economic Advisors, to replace Adriana Kugler on the Federal Reserve Board of Governors. The US president hailed Miran, claiming his expertise in the world of economics is unparalleled. Miran will likely only serve in the role until January 2026, which is when Kugler's term was due to expire. Last week, 2 Trump-appointed governors voted to cut interest rates in a rare instance of double dissent. Speaking to CNBC on Wednesday, Miran touted the strength of the US economy.
Just a couple of months ago, people didn't know exactly where the tariffs would shake out. They didn't know about the investment deals, where those would shake out. And they certainly didn't know the United States would be able to avoid the biggest tax hike in history that would have sent the economy careening into a recession, right? Now, not only is that uncertainty resolved, we know where the tariffs are, we know where the tax bill is, but they're turning into tailwinds with the significant incentives for investment in the tax bill in the form of the full expensing stuff, the significant investment inflows that'll be forthcoming from the agreements that other countries have made to invest in the United States and to purchase American products, and these headwinds are turning into tailwinds, so I'm very confident in the future of the economy.
Here's a look for you at the U.S. trade yesterday. We ultimately ended up with a mixed session. The tech-heavy NASDAQ continuing to charge higher to the tune of a 0.35% yesterday. We saw a marginal pullback in the S&P 500, and the Dow Jones ended about 0.5% lower. For the week overall, Wall Street is higher. Let's take a look at the trade over the course of the last 4 trading days heading into Friday's session. You've got outperformance of the NASDAQ up almost 3% over the course of the week. So tech remains firmly in focus and a key investment spot for investors. We're looking at the Dow Jones up about 0.9%, so lagging, but still in positive territory. Now, in terms of Asian markets, as we mentioned in the open there, we are seeing strong trade in the Japanese market. The Nikkei 225 up 1.7%. This is auto stocks drive higher this morning after the U.S. government promised to amend a presidential executive order to remove overlapping tariffs on Japanese goods. So there had been some concern there around the impact on auto stocks and auto companies, I should say, and there is now relief this morning on that front. The Hang Seng in Hong Kong down by about 1% in the overnight session. Shanghai Composite under a little bit of selling pressure, and similar story for the South Korean Kospi. Over here in Europe, here's the early indication. After the strong session yesterday, we're looking at more gains this morning, fairly muted in terms of the magnitude, but green nevertheless. The CAC 40 looking to bounce about 19 basis points at the open at this stage. Now, over the course of the week, we've also had very strong trade in Europe. The FTSE MIB over in Italy up more than 3.5% over the course of the week. The Xetra DAX up more than 3% as well. The laggard has been the FTSE 100. We have seen a strong pound this week. Yesterday in particular, after that hawkish BOE meeting, and we know that the FTSE 100 tends to move in the opposite direction to sterling. So that index up just 35 basis points over the course of the week. But strong trade overall in Europe.
Juliana, we have had a lot of corporates out this week that have really been explaining how difficult the tariff and business environment has been. This morning, Munich Re has spent about one page in their report talking about just how bumpy it has been, just extracting from that geopolitics, protectionist trade policies, bond yield fluctuations, and also the currency turbulence that they've experienced. So the latest on the back of the report today is that shares in Munich Re are trading lower in pre-market. This after the reinsurer lowered its insurance revenue forecast for 2025. The group citing Forex and business developments, but second quarter net profit still came in above expectations. Christoph Eureka joins us now, the CFO and also incoming CEO of Munich Re. Christoph, thank you so much for joining us. I think what we saw, the colour that you described in the business environment that you were dealing with, just explains how difficult it was trying to navigate. Do you want to just explain it from your lens today, how you managed to get through the latest quarter and keep the numbers intact?
Well, good morning. It's a big pleasure being with you. Indeed, it were two, let's say, very volatile quarters, both on the capital market side, but then for us also very relevant, the loss side. We had a loss-affected first quarter and then the second quarter, which was very benign when it comes to losses for our book. But then on the FX side, both quarters were affected by a negative currency effect. As you know, we report in euro, so US dollar developments impact our numbers. And then, of course, equity markets have been up and down throughout the half year. And also the interest rates developed very differently across the various markets. So it was quite a challenge. And even more, we are happy that our result after 6 months is even ahead of our full year guidance with 3.2 billion of a result. So more than 50% of the full year guidance of 6 billion. So we are very well on track to deliver the full year target despite all these difficult circumstances.
Well, that said, Christoph, if I look at some of the devil in the detail around the investment result, you did have some wins from your fixed income investments and equities. Where you saw some weakness coming through was in the fair value of the private equity investments. This is such a hot area for the markets. Just explain to us where you saw that reset in the valuations.
Well, indeed, the private equity valuations came down for us a bit, but this was very much currency driven. As you know, a lot of the private equity investments are denominated in US dollar, and we report in euro. So the currency fluctuation has a big impact on that. The underlying profitability or the underlying development outside of the currency has been much better and very pleasing indeed in many of those investments.
In terms of your combined ratios, you've reported a pretty strong combined ratios in property casualty, reinsurance, and GSI. Talk to us about what's behind that strength.
Well, the second quarter was very benign. We did not have a lot of new large major losses. And also the runoff of losses from the past developed very favorably. We had to release some reserves for old losses from the past. And then they were even more than offsetting the new losses, at least in P&C reinsurance. And also in GSI, they reduced the loss burden overall quite significantly. So therefore, a very benign quarter with a record low combined ratios, for example, in P&C reinsurance.
Christoph, in your guidance, you kick off by saying you anticipate sustained advantageous business opportunities in the coming quarters. Where do you see the growth coming from?
Well, basically, we are seeing opportunities across the globe. Insurance business grows with inflation, growth with insurance demand, which is only going up on a worldwide scale. And we are prepared to make use of those opportunities globally wherever we get the adequate margin for the risk we take on our balance sheet. And you know, we are so global. We are there for our clients wherever they are.
Christoph, do you want to give us a sense of how you're managing risk in the latest quarter? Because I know it's been an evolution for a lot of the big insurance and reinsurance companies about where they want to be positioned. And in fact, we were talking to one company yesterday about just subtle areas where they were de-risking around the United States. What are you doing differently in this quarter versus previous ones?
Well, I think the one thing I could underline is that we reduced our US dollar long position a bit. So we had been a quite significant US dollar long position starting into the year, and then over time reduced it a bit given the currency fluctuations we saw. And I think benefited from that reduction in the course of the second quarter. Other than that, more operationally, the US continues to be one of our core markets, and we are heavily invested and heavily engaged also in the US insurance market, which is globally one of the most or the most significant market.
Christoph, let me broaden the conversation out here. The industry is facing a major challenge when it comes to natural disasters. Insured losses for these kinds of events reached over $140 billion last year. Do you think that this is the new normal, that we're going to see losses at this level or higher on an annual basis? And if so, what does that mean for your appetite around insuring against these kinds of natural catastrophes?
I mean, we see an upward trend when it comes to large losses from natural catastrophes. In the first half of the year, we saw already 80 billion of insured losses for the industry, by the way, of which 40 billion have been the wildfires in Los Angeles. So we see that upward trend. And so I think the demand is just going to go up. The issue we have in some markets is the question of affordability. And there I think we need to come up with practical solutions which help us covering the demand of the clients, but at the same time keep prices at an affordable level. And there are various models around. We are in many markets part of the discussions around them, and very happy to support. Very often it comes down then to public-private partnerships, which are or have been established in many markets or are yet to be established.
Christoph, do you want to give us a line on premiums? Because for a long time, the market more broadly has been concerned about the premiums coming through from insurance companies and, of course, the reinsurance companies themselves, as we talk about the whole architecture and infrastructure around what sort of premiums are going to be charged. But we did see a lot of the numbers, they were cooling off slightly, but still going up. What are you seeing from your world in terms of what the premiums across the broader industry will look like from here?
Well, it will very much depend on the cover. And I think being a bit more selective on covers sometimes can help to keep premiums on a more affordable level. But finally, I think what is very important is that we, as the industry overall, we charge the risk adequate price for the risks we take. Because this would then also lead to more prevention measures. People would invest more into prevention when they see the real economic price for the risk they take. And therefore, I think there is also a big economic responsibility which lies with our industry to make those adequate prices also very transparent, such that the economy and the societies, the communities globally prepare for a world where the risks go up as we speak.
We talk about risks and opportunities, Christoph. Let me turn to M&A, because I know you've completed the acquisition of Next Insurance, which is a US digital insurer. So that's been bedded down now. What comes next? Are you still looking at further consolidation in the marketplace?
Well, I mean, we've always been very clear about the fact that we are also open to inorganic growth if the right opportunity comes up. And the right opportunity means the strategic fit needs to be very good for us, but also the price needs to be in an economically very adequate level. And as soon as we find a target, we'll happy to execute. The likelihood that this will happen in reinsurance is very low, given our large market share globally already. So therefore, we are speaking about primary or about specialty insurance. And there we are very open to expand our footprint also inorganically.
When I look back at 2025, in terms of, insurance issues, there was a huge surge in high-profile cyber attacks here in the UK, huge focus on M&S, a debilitating cyber attack here. How do you think about the opportunity in global cyber insurance?
Well, I think cyber, first of all, is a strategically very relevant business line. I think it's a task for the industry overall to accompany the society into new risks. And cyber risks are a significant element of the new risks we are facing as a society overall. So it's strategically very important. But also there, the price needs to be appropriate given the risks we take. And in light of the claims development you were mentioning, we saw in certain parts of the cyber markets rates really coming down too much. And not everywhere we can speak of an attractive cyber market. Therefore, and also due to terms and conditions, which we didn't think were adequate everywhere, we reduced our volume quite significantly over the last 2 years. But we are very happy to expand it again if we get adequate prices and terms and conditions.
Interesting colour there, Christoph. Thank you so much for joining us. We appreciate the time and the conversation. Christoph Eureka with us, the CFO and incoming CEO of Munich Re. Insurance groups fear accelerating climate change could soon make the world uninsurable. You can check out that piece on our website, CNBC.com. Intel CEO Lip-Bu Tan has responded to calls from President Trump for his resignation, telling employees the company is engaging with the administration to ensure they have the facts and that Intel's board is supportive of his work. It comes after Trump railed against the CEO on Truth Social, describing him as, quote, highly conflicted after Republican lawmakers raised concerns over his ties to Chinese companies. Those comments sent Intel shares sharply lower in Thursday's session.
Elsewhere in the tech world, OpenAI has launched GPT-5, with the AI startup hailing the update to its flagship large language model as smarter, faster, and more useful. The company, which is reportedly in talks with investors about a potential stock sale at a valuation of roughly $500 billion, said it is making GPT-5 available to everyone, including its free users. We'll hear from OpenAI CEO Sam Altman later today. Don't miss that conversation at 1 p.m. London time. Coming up on the show, Japanese auto stocks rebound as a D.C. meeting raises hopes that promised tariff easing could be imminent. Plus, Bank of England Governor Andrew Bailey tells CNBC the exact path of rates is uncertain, even as he reiterates they are on a downward slope. And we'll break down the latest geopolitical developments with Tina Fordham from Fordham Global Foresight. That conversation is coming up at 8:30 London time. Israel's security cabinet has approved a plan to take control of Gaza City in a move which escalates the country's ongoing war with Hamas. The Prime Minister's office said in a post on X that the IDF will prepare for taking control of the city whilst distributing humanitarian assistance to Gaza's civilian population. Speaking to Fox News before the vote, Netanyahu reiterated his goals in the ongoing conflict.
We intend to, in order to assure our security, remove Hamas there, enable the population to be free of Gaza, and to pass it to civilian governance. That is not Hamas and not anyone advocating the destruction of Israel. That's what we want to do. We want to liberate ourselves and liberate the people of Gaza from the awful terror of Hamas.
Let's move on to markets. Japan's Nikkei and TOPIX have both hit fresh record highs this morning, after Tokyo's lead trade negotiators said the U.S. administration promised to amend an executive order to stop the country's new 15% tariff from stacking on top of existing duties. U.S. officials are said to have pledged an executive order to reduce auto tariffs to the 15% level, in line with the agreement reached between the two countries last month. Lin Lin filed this report.
Japan's top trade negotiator, Ryosei Akazawa, has been in Washington this week seeking clarification on the trade deal with the US. After meeting with key officials, including Treasury Secretary Scott Bessent, Akazawa-san confirming two key details: that an executive order implementing the agreed auto tariff cut to 15% is coming, and that Japan will be a beneficiary of an exemption like the EU in terms of tariff stacking, meaning if a Japanese product had prior to August the 7th faced a duty of 4%, that figure would not be stacked on top of the so-called reciprocal rate, which kicked in yesterday. Akazawa-san saying that the US has conceded that it was an administrative mistake and that it will be corrected when President Trump issues the executive order for the implementation of the new auto tariff for Japan. The US will also reimburse all the excess tariffs collected. However, what is still not clear is when the order will be issued. Lin for CNBC Business News.
This story had potentially a lot of legs as we talk about the fallout for other nations that have been negotiating with the US president and with the other officials in the administration, because the story suggested that just because you had a great deal or a deal as an outcome of the negotiations doesn't mean that was the worst of it. The tariff stacking story that the 15% could be added to existing tariffs, I think, was a shockwave story potentially for other nations that thought, well, we thought we had gone through this whole process only to emerge on the other side with potentially even worse news. So the clarity here really important, but I think also the learnings too about how to conduct business. Japanese negotiators, you think, very clearly, very well established, but the negotiations with the president himself, the trade negotiator, and with the US officials did not come with any signed document. And there was no joint statement that was issued by the Japanese Prime Minister as well. So a lot of criticism about going down that pathway, not putting pen to paper. And this has been something that has emerged with other countries too. Look, where is it in writing? Where is this binding? And is it something that can be simply changed with a sweep of a pen or a megaphone from the president down the track? So the lasting uncertainty here, if you're not putting pen to paper, is an issue, I think, for a lot of countries to look at this Japanese story today.
In terms of the market reaction, it does suggest that investors are breathing a sigh of relief that we're not going to get stacking here. You're seeing quite strong trade in the Japanese automakers overnight. When you talk about not having a signed agreement at this stage, the EU and the US still don't have anything signed. And even when President Trump was asked earlier this week by our US colleagues for clarity on the $600 billion that the Europeans have committed to invest in the US, there was no way to really push back on exactly what that meant because nobody has seen it in writing here. And there's been a real discrepancy around what it means, with the Europeans saying this is all about intentions. It's going to be up to companies. This is going to come from the private sector. And then you've got President Trump saying, I have complete liberty to decide where this money is going, what it's being invested in. And until we have anything on paper, I think, like to your point about this Japanese story, we just don't know how to judge it.
Well, you can see the president deciding to wake up one morning and saying, where is the money? And just taking aim at a particular country. And if you look at the 600 billion number you mentioned from the European side, $550 billion is the number two that the Japanese premier has agreed to offer over, and this will be backed through government loans and guarantees as well. So there seems to be a number here that is in the president's mind that he is asking countries to sign on to. He's also likened it to a sporting analogy that it's like a baseball player's sign-on bonus, that Washington will also get the sort of sign-on bonus from different countries. So will the money go to profitable ventures and ventures that yield any result? If you've got money chasing a home, if it's almost like a blanket check here, where does that money actually derive some sort of an outcome for the market and for investors?
If it really is a blank check. And I think when it comes to Switzerland, it'll be interesting to see if that becomes a sweetener here as part of any potential deal between the Swiss and the U.S. Will we see the Swiss go down the route of promising investment of that scale in the United States?
Let's push on and take a look at some company news. Deutsche Telecom CEO Tim Höttges has told CNBC he sees a more competitive environment in Germany, but that the country still has huge bureaucracy. His comments come after Deutsche Telecom raised its core profit guidance for 2025, but shares fell as investors focused on weak demand in its home market. Höttges told CNBC the company is looking to defend its position in a price war.
We see a much more competitive environment in Germany. By the way, we are doing very well on the mobile side, being on B2B and on B2C. This is good on track, and we have gained new customers here as well. The competition is very intense on the broadband market. By the way, on this classical broadband market, which is the copper environment, we see a lot of competition from the altnets, the alternative networks where they're building out, focusing on more homes connected these days. increase. And what we see as well is, that our classical competitors are focusing very much on retaining their customers by very low prices. And that creates headaches because the profitability of this fiber market is anyhow already challenged in our markets. The build-out costs are very high. And on top of that, now the consumer price is going down at the same time. That worries me. Our competitors are shrinking in this market on service revenues and on EBITDA. We are still growing, but nevertheless, you're totally right. There's a lot of competition going on.
So what would you need to have, like also from a regulatory framework, to actually be able to grow more?
I don't want to be, killed in a price war which is taking place here. We are focusing on what telecom stands for. We are the premium providers in the market with our proposition on service and on network quality, and that is what we continue. The value which we are creating for the customers in the focus. So therefore, we are continuing to build out fiber, 2.5 million households this year in Germany. We focus on trying to segment the customer base in a better way, even regional segmentations, so that we are defending our positions in areas where we are highly attacked with lower prices, but not for the overall markets. And on top of that, we are trying to reduce the build-out costs supported by the new initiatives from the government. Just a number, the build-out costs in Germany are 8 times higher than the build-out cost, for instance, in Spain. And therefore, the profitability of this whole fiber market has to improve, to succeed on the penetration of fiber here in this environment.